I'm Steve, and I am not your typical accountant. How can I reduce my tax bill in Canada? Today I'm going to show you how to use your investments to lower the amount of money you're going to have to ultimately give the government at tax time. Before we go any further, I have to shamelessly ask for you to smash the like button and subscribe. It's encouraging to us. It's how we're able to make more videos. And if you've got any suggestions, by all means, write in the comment section. We want to hear from you. The three things we're going to talk about today are offsetting your capital gains, making charitable donations, and using prescribed rate loans. How do we define capital gains? Capital gain is when you sell an asset like a stock, a bond, a mutual fund, or a piece of real estate for a higher price than what you paid for it. That creates a capital gain. A capital loss is just the opposite, when you sell one of those assets for less than what you paid for it. Offsetting your capital gains. The stock market's been on a crazy tear this year and for a number of years, so many of you are going to have some large capital gains inside your holdings. We're talking about holdings that you have outside your registered accounts. So we're not talking about your tax-free savings account, your RESP, or your RSP. For stocks, mutual funds, and bonds that you hold outside of your registered account, so in a normal trading account, there's some maneuvers that you can make that can help you save how much tax you're ultimately going to have to pay the government this year. Sometimes it's called tax loss selling. In a nutshell, what we're looking at is reviewing your entire portfolio. If you have an investment advisor, we absolutely recommend you going over this with them. If you handle your investments yourself, what we're talking about is having a look at the assets that you have that have gone down in value in comparison to what you paid for them. There's an opportunity at year end to sell these and take the loss, apply that loss against other capital gains that you've made throughout the year. Now, like so many things in tax, there's a lot of rules around exactly how you do this. First of all, it's important to note that capital losses can only be offset against capital gains. So what you cannot do is sell at a loss a stock that you have and claim that against income from a job. It doesn't work like that. The only thing you can claim a capital loss against is the capital gain that you've had from some other transaction, either a stock sale or a real estate sale, mutual fund, bonds, things like that that you've sold at a profit, creating a capital gain. The maneuver we're talking about here is selling something that's lost money to offset that gain. So that's the first thing that's important to note. The second thing that's important to note about tax loss selling is that the asset that you're looking to sell, you can't just sell it today and buy it back tomorrow. So if this is a stock you're really passionate about, but you're thinking, I can get rid of it today, I can take some loss, and then I'll buy it back tomorrow or next week. The rules are actually very clear that you cannot own this stock, and not only can you not own it, but your corporation that you control, your spouse, your children, a trust that you control, none of those entities can own this stock for either 30 days prior or 30 days after the sale date. So in real world terms, for most of us, it means if we sell this stock, we simply can't buy it back in any account or have anybody we're related to or any corporation that we own buy that stock back within 30 days. So if you're selling this, you're really selling it and taking the risk that I'm selling it and I'm not going to own this, whatever it might be, for the next 30 days. Something to consider before you trigger tax loss selling is, do you have any other losses that you're carrying forward from previous years or earlier in this year? So you can't just look at the stocks that you've got today and say, well, maybe I should sell some of them at a loss. You want to review with your advisors and see, am I carrying forward any tax losses, again, from either earlier in the year or from previous years. And if you've sold some of your assets in your non-registered accounts for a gain, so you've made a capital gain, one thing that you can do is to sell some of your dogs, maybe some of the stocks that have gone down in value prior to year end, and crystallize that loss. You can use that loss to offset against your capital gain. Something else to be aware of is that the transaction does have to close prior to the year end. You want to check with your trading platform or your advisor the last date that you can possibly sell to be sure that you're triggering the sale before that. Things like mutual funds have a multiple day closing period, and as we get into the holidays, the trading platforms aren't open 24 hours, 7 days a week. We're not talking about cryptocurrency here, guys. So you've got limited days where you can sell and make sure that the transaction is crystallized and closed before year end to ensure that this loss can be written off against your other gains from the year. Another strategy to use along with this is that even if you don't have capital gains for this year, if you've got capital gains in any of the previous 3 years, you can trigger a loss by selling a stock, a bond, a piece of real estate, or a mutual fund at a loss before December 31st this year, carry that loss back against any capital gains that you had in the previous 3 years. So even if you've held on to all of your stocks this year, haven't realized a capital gain yet, but you did in the previous years, you can use a loss to go back and recapture some tax that you've paid in previous years. The last thing we want to talk about today in capital gains is that the current government might increase the inclusion rate for capital gain. What's the inclusion rate, you ask? Capital gains currently in Canada are only included at a 50% rate. What's that mean? It means that if you make $1,000 in capital gain, you only actually claim and pay tax on $500 of it. There's been a lot of talk, and in the past, they have absolutely changed that rate both up and down. The current talk is that it could very possibly go up. And in fact, the NDP government would like to see that inclusion rate at 75%. So there's some serious thought that needs to go into the capital gains you have this year, whether we want to trigger any capital losses to get that offset, and how you want to set yourself up going forward, knowing that the inclusion rate might be higher in future years. It's a hard thing to plan for, the unknown, but it's certainly a possibility, and among tax preparers and investment planners, it's certainly a topic of discussion that the government very possibly could increase this rate. The last time a change was made, it was made quickly. As of that date, the rule had changed. So even though it wasn't budget time, they made the change immediately. So it's very possible that a change to the inclusion rate of the capital gain could change without any notice. Number 2 today, to save you taxes, is making charitable donations. Now, most of us don't make charitable donations simply to get the tax deduction, right? We give to charities that we believe in because we believe in what they're doing as a charity. We believe in the help that they're giving to society, and there's lots and lots of charities to choose from. How are we tying your assets held inside your trading account? Again, not your tax-free savings account, not your RSP, not your registered education savings plan, but stocks, bonds, and mutual funds held in your regular trading account. How does that tie to charity? Well, a few years back, the government made an interesting change. And what that was is that if you donate a stock, that has a capital gain. So again, we paid $1,000 for a stock or a mutual fund or a bond that's maybe worth $1,500 today. If you donate that, 2 things happen. First of all, you get the donation for the full value of that asset, in this case, $1,500. What you don't get is the tax bill for the capital gain. So it's a great way to avoid capital gain. It's not you're avoiding it. The tax laws actually say you're allowed to donate this. You get the benefit of the higher value without having to claim the income on the gain that you made. So it's a win-win for everybody. You get to donate to the charity for the higher amount, so you pay less tax, and the charity wins because they're getting a higher donation than maybe you would have given if you were giving it in cash, or if you had to pay the tax on selling that. So a great way to give to charity, again, is to, instead of cashing in one of your assets and giving them the money that's left over after you pay tax, is to actually donate the bond or the mutual fund or the stock directly to the charity. Now, important to note about this, again, is timing. First of all, not all charities will accept marketable securities as a form of donation. So you have to find out who does and who doesn't. And the second thing is, this takes some time. You can't go in on December 20th to a charity and say, hey, I'd like to give you $10,000 worth of this stock. There's a process that has to happen. So if you want this deduction for 2021, you need to start working on this today to make sure that you found a charity that accepts marketable securities as a donation, and that you get the paperwork and the transaction so that they've actually taken ownership of those stocks, bonds, or mutual funds prior to the end of the year so that they can issue you your charitable donation. Number 3, use prescribed rate loans. Now, Tyler, one of my team members, said, what the F is a prescribed rate loan? That's a great question, and this does not get utilized as much as it could. Now, there's some conditions you have to make this make sense. First of all, you have to have a spouse, because we're talking about loaning money from one person to another. And it works best with a spouse. It can also work with children or grandchildren, depending on your situation. The second thing is you have to have people that are in a different tax bracket than yourself. If you and your spouse are in the same tax bracket, then using a prescribed rate loan is not going to matter. Prescribed rate loans, in a nutshell, the government says that you can lend to your spouse, your children, or your grandchildren a set amount of money that they can invest. People often ask, how much money can I give my spouse? How much money can I give my children or grandchildren? And the short answer is, if it's truly a gift, you can give them anything you want. The government can't stop you from giving family members money. What they can say, though, is that if you give these people money and they invest it, and it really isn't their investment, it really wasn't a gift, you're just trying to, have them pay the tax on the capital gains or dividends or interest that investment makes, that they're going to tax that money back to you. They're going to make you pay tax on it in the higher rate. So the way to avoid that is by using the prescribed rate loan. And so what this says is that you can lend your spouse, if they are in a lower tax bracket, say $10,000 or $100,000, and as long as you charge them the prescribed rate of interest on that loan and claim that interest as income on your tax return, okay, your spouse then gets to claim any income that the investment makes, as well as the interest on that loan that they pay you as a deduction. So if you're a high income earner and you're in the 50% tax bracket and you've got an investment that's made $1,000, it's going to cost you $500 in tax, all other things being equal. If your spouse is in a 20% tax bracket, they would then only pay $100 on that same $500 gain. Clearly that means the government's getting less money and the family's keeping more, which is kind of the point of tax planning. By using the prescribed rate loan, your spouse simply has to ensure that they have paid you. And we can't just say that they paid you the interest. The transaction has to happen. Write the check, make the bank transfer. It's important that the government can see the money actually changed hands. Even if it came out of a joint bank account and went right back into that same joint bank account, write the check out. Not that anyone uses checks. It's important that there is a paper trail for this, because the government really wants every reason to take the investment income and tax it in the higher person's hand, the higher taxed person's hands. So make sure that you're following the paperwork. Now, what is a prescribed rate? That's also a great question. The government actually comes out quarterly and says, this is how much you have to charge your spouse, your children, your grandchildren to qualify for a loan that it would be taxable income to you, tax deductible by the person borrowing it because they're using the money for investment purposes, and ensures that the money that the investment makes is taxed in that other person's hand. The prescribed rate for the fourth quarter of 2021 is a whopping, guess what? Here we go, drum roll please, 1%. A deadline that's important to know about this is the person paying the interest must pay it before 30 days after the year end. So in practical terms, this would be before January 30th. That check, the transfer, has to happen to show that the interest was definitely paid on that loan. Check out our next video for more year-end tax saving tips. I'm Steve from the TaxForce, and I'm not your typical accountant.